All right, today we're going to tackle a really interesting puzzle from the world of investing. It's a situation that, on the surface, just doesn't make sense. We're going to look at how a company can miss its earnings targets, the big numbers Wall Street watches, and yet still be called a wonderful business. It's a great reminder that you've always got to look past the headlines.
So yeah, this is the big question we're digging into. How can a company miss its earnings and still be considered a wonderful business? I mean, it sounds completely contradictory, right? Usually when a company misses expectations, the stock gets hammered. But what if there's something else going on? What if the real story is hiding in plain sight? Let's find out.
Okay, so let's get right into it. The whole puzzle starts with a company called Erie Indemnity and its recent earnings report.
So here are the raw numbers. The facts are pretty simple. Wall Street analysts, they were expecting earnings per share, that's EPS, of about $3.09. What did the company actually deliver? $2.75, a miss. Okay, what about revenue? Forecast was for $966 million. They came in at $951 million, another miss. So by any standard measure you look at, this was a clear miss on both the top and bottom lines. No way around it.
So case closed, right? The company missed, end of story. Well, not even close. You see, while all the headlines are screaming earnings miss, the really savvy investors, they're looking at this and seeing something completely different. Something special. To understand what they see, we have to stop looking at the what and start digging into the why.
And to really crack this puzzle wide open, we need to pull out a special tool from our investor toolkit. It's a concept made famous by, you guessed it, the legendary Warren Buffett. And it's all about finding businesses with a powerful, long-lasting competitive advantage.
And Buffett's analogy is just perfect. He says, in business, I look for economic castles protected by unbreachable moats. Think about that. He sees a great business like a strong castle, and the moat, that's whatever protects the castle, whatever keeps the bad guys, the competitors, from getting in. And the wider and deeper that moat is, the safer the business is.
So at its core, an economic moat is a business's ability to keep its competitors at arm's length for a long, long time. It's not just about having a great product today. It's about having some kind of structural advantage that makes it incredibly hard for someone else to come in and steal your lunch money. This is what gives a company real, long-term staying power.
And, these moats come in a few different flavors. You've got things like intangible assets. Think of a brand like Coca-Cola or a patent on a drug. There's a cost advantage where you can just make stuff cheaper than anyone else. Then there's the network effect, like Facebook, where the more people who join, the more valuable it becomes for everyone. You also have high switching costs, where it's just a huge pain for customers to leave you for a competitor. And finally, efficient scale, where a market is really only big enough for one or two major players.
Okay, so now that we know what a moat is, let's bring it all back to our puzzle, Erie Indemnity. Because it turns out this company's entire business model is its moat.
And this right here is the absolute key to understanding everything. Erie Indemnity doesn't actually sell insurance. That's not their game. What they do is manage an insurance exchange for a fee. Think of it like a toll bridge. Every time a premium dollar wants to cross the bridge into the insurance exchange, Erie collects a little toll. They don't take on the risk of the cars crashing. They just collect the fee for using the bridge. This little comparison shows you just how different their model is. A typical insurer, they collect premiums, sure, but they have to hold on to mountains of cash just in case there's a huge hurricane or a massive earthquake. They're taking on all that risk. But Erie? No, they just collect that management fee. They don't need huge capital reserves because they're not on the hook for those catastrophic losses. It's a much, much less risky business.
All right, so this toll bridge idea sounds great, right? But a powerful moat can't just be a good story. It has to show up in the financial results. If this business model is really as good as it sounds, we should see stone-cold proof in the numbers year after year. And here's the proof. Take a look at this number, 26.7%. That's Erie's average return on equity, or ROE. Now, all ROE measures is how much profit a company makes for every dollar of shareholder money it uses. And Erie's number is spectacular. It's more than double the industry average of about 12.5%. That's the toll bridge model in action right there.
But it's not just about being super profitable. This thing is a growth machine too. Check this out. Over the last 5 years, Erie's earnings have grown, on average, at a whopping 19.2% per year. The rest of the insurance industry? Just 12.4%. They are absolutely blowing past their competition.
And this isn't some new flash in the pan. This company has a long history of rewarding its shareholders. I mean, look at these numbers. They've been growing their book value per share by 14% a year. They've paid a dividend for 31 consecutive years. That's incredible consistency. And they're not just paying it, they're growing it by over 7% recently. It's just a fantastic track record.
Okay, so let's recap. We've got a fantastic toll bridge business, a deep economic moat, and absolutely stellar financial performance. Which brings us right back to the beginning. If the business is so great, what on earth explains that earnings miss we started with?
And here it is, the big reveal. The reason for the miss had nothing, and I mean nothing, to do with a problem in the business. It was a completely intentional, one-time event, a $100 million charitable contribution.
The accounting here is actually super simple. Let me walk you through it. First, the company makes this huge $100 million donation to start a new foundation. For accounting purposes, that donation gets booked as an expense for the quarter. Now, a big one-time expense like that is going to reduce your net income, right? And when your net income goes down, well, your earnings per share goes down with it. And that's it. That's what caused the number to come in below what the analysts were forecasting.
And the company wasn't trying to hide this at all. The CEO, Tim Nicastro, he got on the earnings call and basically said, yep, we know this impacts our short-term earnings. But he made it really clear that this decision was all about the company's long-term values. So you see, this wasn't a screw-up, it was a choice, an investment in their community.
Okay, so now we know the earnings miss was just a distraction, a total red herring. And we've confirmed that Erie is an incredibly high-quality business. But for an investor, that's only half the job, right? Now we have to talk about the final and maybe the toughest piece of the puzzle, the price.
And this is where we get to the classic investor's dilemma. On one hand, the bull case, the reason to be optimistic, is crystal clear. You've got this wonderful toll bridge business with a durable moat, amazing returns, and a great dividend history. But then there's the bear case, the reasons for caution. The big one is that the market knows this is a great business, so the stock is almost always expensive. Plus, you've got a CEO transition coming up, and of course, a competitive marketplace. It's a real tug of war. And that brings us to the final, critical question that every single investor has to wrestle with. We've solved the mystery of the earnings miss. We know Erie Indemnity is a fantastic business, but the market knows it too. So for a truly great company, one of those economic castles with a huge, unbreachable moat, what price is too high? That right there is the puzzle you have to solve for yourself.